Welcome back to the deep dive. Okay, so you've got the latest from VGuard Industries Limited, the Q2 FY26 results, press releases, all that good stuff from October 29th.
That's right. And our mission today really is to cut through the noise. VGuard called it modest consolidated growth, but that headline number, it hides a lot.
Always does.
We need to dig into their different businesses, electronics, electricals, consumer durables, and Sunflame too, to see, well, where things are working, where they hit roadblocks, and what they're planning next.
Absolutely. So let's set the scene with those top-line numbers. Q2 FY26 consolidated net revenue from operations came in at 1,341 crore.
Which sounds okay, but it's only 3.6% growth compared to last year. Just 3.6%.
And the profit after tax, also kind of sluggish, grew just 3.0% year over year, landing at 65 crore.
And you really need to zoom out a bit, look at the whole first half, H1. Revenue growth there was even weaker, just 1.3%.
Wow.
Yeah, and even worse, the profit after tax for that first half actually dropped, down 14.3% compared to the previous year.
Ouch. So if the first 6 months are looking like that, it suggests, well, some pretty significant challenges underneath.
Definitely. It's not just a one-quarter blip.
So speaking of challenges, management talked about external headwinds, right? Beyond just saying weak demand, what did the MD point to specifically?
They highlighted three main things. Number one, and probably the biggest headache, was the weather. A really heavy, prolonged monsoon season.
Okay.
Second was, that general weak demand, consumers being cautious. And third, they mentioned the sort of ongoing effects from the GST transition, specifically these GST 2.0 reforms that everyone hoped would boost spending. Well, that boost didn't really show up in Q2.
That monsoon factor is really interesting when you think about VGuard's products. It's not just like inconvenient weather. It hits them from multiple angles, doesn't it?
Oh, absolutely. It's kind of a perfect storm for them.
How so? How does a heavy monsoon hurt both, say, consumer durables and electricals?
Well, the intense rain directly kills demand for stuff like fans and air coolers.
Yeah.
Peak summer products, right?
Right.
So that slams the consumer durable segment.
Right.
But at the same time, all that rain, it slows down construction activity. That means less demand for their wires, switchgear, things like that in the electrical segment, especially on the B2B side.
Ah, okay, so you see it hitting both sides, which makes that overall 3.6% growth number feel even more like just an average, hiding the real picture.
Exactly. So let's break down those segments. Q2 revenue growth year over year. Electronics actually led the pack at 5.3%.
Okay, not bad.
Electricals was next at 4.7%.
Yeah.
Then Sunflame, the kitchen appliance business, grew 3.4%.
And bringing up the rear.
Consumer durables, the main weather victim, as you said, just 1.0% growth, barely moved.
Wow. So revenue is one thing, but the profit story must be where the real action is, especially in electricals, you mentioned.
Yeah, electricals is fascinating.
I mean, the numbers are kind of wild. Revenue grew, 4.7%? But the segment result, the profit jumped a massive 32.3% year over year, pushing the margin way up from 9.1% to 11.6%. I mean, how is that sustainable or just a one-off?
It's largely a one-off. You nailed it. Management was pretty clear. They called it an inventory benefit, specifically on house wiring cables.
Inventory benefit, meaning?
Copper prices shot up sharply during the quarter. VGuard happened to be sitting on inventory they'd made when copper was cheaper, so they got to sell that cheaper stock at the new, higher market prices.
Ah, okay. So a nice little windfall from commodity prices going their way. Selling old, cheaper stock at new, inflated prices boosted the bottom line nicely for the quarter.
Exactly. But you wouldn't want to model that margin level going forward. It was a helpful cushion, though, given the weak top line.
Right. And still within electricals, you mentioned pumps were flat.
Yeah, another direct weather link there.
Yeah.
The heavy monsoon meant the water table was high, so fewer people needed to rush out and replace their pumps. That capped the revenue growth for that part of the segment.
Okay, so electricals had this temporary profit boost. Now let's contrast that with consumer durables. That was the real casualty, wasn't it?
Absolutely brutal. The segment result just plummeted, down 57% year over year.
57%.
Yeah, and the margin? Crushed. Fell from 4.1% last year down to just 1.7%, basically wiped out.
And that's purely down to the unseasonal rain hitting fan and cooler sales.
Pretty much. Those are big-ticket items for that segment. When the peak season gets washed out, the sales volume just isn't there to cover the fixed costs. Margins collapse. It's the tough reality of seasonal products.
Okay, but then we look at Sunflame, the kitchen appliance business they bought. That looks like a totally different story. A massive 380% jump in the segment result. Margins up to 6.5% from 1.4%. What happened there? Sudden magic.
not quite magic. It's more about normalization and starting to see those merger benefits. You have to remember, the comparison base last year was super low.
Why was it so low?
Management said it was bogged down by transition issues and costs related to the acquisition, heavy integration expenses.
Gotcha. So this big jump is really just getting back towards a healthier level after all that disruption.
Exactly. And they're actually pretty ambitious about where it can go. They're talking about Sunflame hitting around 12% EBITDA margin in the next 2 to 3 years as all those synergies like better sourcing and shared services really kick in.
Okay, that makes sense. And quickly, the electronics segment. Led on revenue growth, 5.3%, but profitability actually softened a bit. Margins down from 19.6% to 17.2%.
Yeah, that was mostly about product mix, it seems. Stabilizer revenue was down a bit.
Maybe fewer people buying supporting gadgets.
Could be. They did see decent growth in inverters and good growth in their solar business, but the overall blend of products sold just wasn't quite as profitable as the year before. Management thinks the normal, sustainable margin for electronics should be somewhere between 17% and 18%, so it's not drastically off.
Okay, so profitability seems relatively stable there, just a mixed issue this quarter. Now, profitability is great, but V-Guard has always been trying to grow beyond its traditional stronghold in the South. How's that geographical diversification going?
It's a slow grind, but it's moving forward. In Q2, the South markets grew 4.3% year over year. Non-South markets grew a bit slower, 2.8%.
So the South still outperformed.
Slightly, yeah. But the key thing is the share. The non-South region now makes up 44.1% of their total Q2 revenue, excluding Sunflame.
Okay, so nearly half. That shows they are making progress expanding outside their home base, even if it's maybe slower than they'd hoped.
Exactly. The trend is definitely in the right direction.
Let's talk about overall financial health now, because there's this interesting tension between gross margin and EBITDA margin.
Yes, this is a really important point.
On the one hand, gross margin looked good, right? Expanded 140 basis points year over year, hit 37.6%. That suggests they're managing their input costs pretty well.
Absolutely. That's a positive sign about internal efficiency. They're holding on to those gains.
But despite that strong gross margin, the overall EBITDA margin actually declined, slipped 40 basis points, down to 8.1% from 8.5%. So why couldn't they convert that good gross profit into better operating profit?
It boils down to operating leverage, or rather, the lack of it. Meaning they have significant fixed costs, like overhead admin staff, marketing budgets, running those new facilities. These costs don't change much whether sales are booming or just trickling in.
Right.
When your top-line revenue only grows by a weak 3.6%, like it did this quarter, you just don't have enough sales volume to spread those fixed costs over. The costs are there, but the sales aren't high enough to absorb them efficiently. So even though they manage input costs well at the gross level, the weak volume crushed the operating leverage, pulling the EBITDA margin down.
So weak demand is the real bottleneck preventing higher profitability right now. Makes sense. But on the balance sheet side, things look much better.
Oh yeah, much healthier picture there. Their net cash position improved dramatically. They went from having just about 4 crore in net cash a year ago to almost 93 crore as of September 30th.
That's a huge swing.
Very strong cash generation. Shows good discipline internally. They also got better at collecting money. Debtor days improved from 32 down to 28.
Faster collections, always good.
Yeah. Overall, working capital days ticked up slightly, but the underlying cash flow and liquidity are definitely much stronger. They're building a solid financial base while they wait for demand to pick up.
Okay, let's shift to strategy then. The Sunflame integration seems critical. What are the main benefits they're trying to unlock there?
It's a lot about back-end scale and efficiency.
Yeah.
They're looking at cutting logistics costs, merging customer service operations, improving quality control across the board.
Standard integration stuff.
Right. But maybe the biggest lever is sourcing power. Management kept emphasizing that Sunflame now gets the benefit of V-Guard's overall size, the might of a 6,000 crore company, as they put it. That should really help them negotiate better prices for components and materials, boosting Sunflame's margins over time.
They're also pushing hard on backward integration, especially making their own batteries for inverters. What's the plan there?
So phase 1 of their battery manufacturing is up and running. Right now, they're making maybe 40–50% of the batteries they need for their inverter sales internally.
Okay.
The plan over the next couple of years is to ramp that up significantly, aiming to produce 70–80% of their battery needs in-house.
And the goal there is purely margin improvement.
Pretty much. Making it themselves, especially as volumes grow, should give them better margins through operating leverage compared to just buying batteries from outside suppliers.
And it's not just standard batteries. They're talking about this Gagadyne technology. That sounded quite different.
Yeah, that's a potentially big deal. This isn't just making more lead-acid batteries. Gagadyne uses a different chemistry.
How is it different?
They're promising significantly longer life and safer performance compared to traditional lead-acid or even the standard lithium batteries you see now. The plan is to start launching V-Guard inverters paired with these high-performance Gagadyne batteries sometime around Q4 of this fiscal year or maybe Q1 of the next.
So a real attempt at technological differentiation, setting themselves apart.
Exactly, a potential premium offering.
Now, we see other electrical companies doing really well in the B2B space. Big government projects, infrastructure builds. V-Guard seems a bit more hesitant there. Why?
Yeah, they're cautious. They're dipping their toes in, exploring things like B2B solar pumps, but they see that market as, well, kind of lumpy, very dependent on government tenders, which can be unpredictable.
Okay.
But the bigger issue, fundamentally, is their setup. V-Guard's whole sales and distribution machine, their go-to-market strategy, is built around B2C reaching individual consumers through retail channels.
Right, that's their strength.
It is. But that B2C engine isn't really designed for chasing large B2B deals, like supplying massive amounts of cable for a big construction project or complex switchgear for industrial use. That requires a different kind of sales team, different relationships. So they're currently limited and competing for those big B2B contracts that benefit some of their rivals.
They need to build a whole new capability, essentially.
Pretty much. That's a different GTM engine.
Okay. Last thing on the horizon, new fan regulations coming January 1st, 2026. Energy efficiency norms? How's that going to impact things?
It's definitely going to shake up the lower end of the market. These new norms mean manufacturers will have to raise prices on the basic economy fans, the 1-star or 2-star equivalent models.
How much of a price hike are we talking?
Probably in the range of 5 to 8%.
Which could dampen demand at that price point.
Could do, yeah. But V-Guard management seemed relatively unconcerned for their own business. They pointed out that they aren't actually a huge player in that very basic entry-level economy segment.
So the impact on them might be limited.
That's the idea. Since they focus more on mid-range and premium fans, the disruption at the very bottom end won't hit them as hard as it might hit companies that rely heavily on those economy models.
Makes sense. Okay, looking forward then. After this pretty tough first half, what's the final word on their initial, quite bullish annual growth guidance?
Yeah, they had guided for 14–15% growth for the full year. They've now officially walked that back. Management confirmed that target is unlikely given how H1 performed.
So new guidance coming later.
Exactly. They said they'll give an updated outlook when they release the Q3 results after they see how the crucial festival season demand shapes up.
And investment plans?
CapEx? That seems steady. They're still planning to spend around 120 to 130 crore this year and probably a similar amount next year, mostly focused on their R&I center and upgrading manufacturing facilities.
Okay, so let's try and pull this all together, wrapping up our deep dive on V-Guard's Q2. It feels like a story of, well, good internal housekeeping meeting some really rough external weather.
I think that's fair. You saw definite signs of internal health. The gross margin expansion was real. Cash generation was very strong. They got that unexpected profit bump in electricals from copper. But the external environment, primarily the bad weather and just generally weak consumer spending, really hammered their consumer durable segment. And because the overall top-line growth was so weak, they couldn't get the operating leverage they needed. That kept the EBITDA margin suppressed despite those internal efficiencies.
So the company seems to be doing its part internally, solid balance sheet, clear strategic moves with Sunflame and Gagadyne.
Yeah, the foundation looks pretty solid.
Yeah.
But ultimately, they're really waiting for the tide to turn on consumer demand. They need people to start feeling confident enough to spend again, especially on those durable goods, to really unlock the potential profit from all that internal work.
Which leads perfectly into our final provocative thought for you, the listener, to think about. Management made an interesting comparison. They said the kitchen appliance category, which is part of that weak consumer durables segment, has incredibly deep penetration in Indian households. Almost like FMCG goods, basic staples.
Things most households already have in some form.
Exactly. So if demand is soft, even for these deeply penetrated, almost non-discretionary items, What does that really signal about the underlying health of consumer spending, particularly discretionary spending, the nice-to-haves?
Yeah, if even the basics are showing weakness, what does that imply for spending on bigger ticket items or upgrades across the wider economy in the coming months?
That's the big question, isn't it? It suggests the overall consumption recovery might still be quite fragile, something definitely worth keeping an eye on, because VGuard's future performance really hinges on that broader economic sentiment.
It's a potential warning sign for the whole consumer sector, not just VGuard.
Food for thought. Thanks for diving deep with us today. We'll catch you on the next one.